Welcome to the Accountability Show. Thank you so much for tuning in, and make sure that you subscribe to the YouTube channel and turn on your notifications so that you know when every episode drops. We're dropping an episode every single week, and we're talking about the 12 steps that are going to lay a strong accounting foundation for your business. Because after all, if you don't know the numbers in your business, it's going to be really hard to run your business effectively and make this business run for you rather than it running you around all the time. If you ever feel like that you've been on this hamster wheel before where you just continue, money goes out the door, money comes in the door, money goes out the door, money comes in the door. It's exhausting. How would you like to be able to, basically push a button or take some action and know that it's going to produce a certain amount of money? What we're talking about today is going to make that happen in your business. And we've been discussing the last couple of weeks, balance sheets, income statements, how to read a financial statement. Why do you need a financial statement, and what is a financial statement? Today we're talking about the how. How do you read a financial statement? And I covered this a little bit in the last two episodes because all of these questions, the what, the why, the how, they all kind of mesh together every now and again, but especially when you're talking about financial statements. So let's start out real quick. What is a financial statement? When you say a financial statement in a business, you are referring to the balance sheet and the income statement in that business. Some might call the income statement a profit and loss. If you never heard that before, that's okay. I've run across a lot of business owners. I've said, hey, get your profit and loss statement. They're like, what? What are you talking about? I'm like, the statement that says whether or not you made money. Some people know it as that. Some people don't know it as an income statement. But an income statement basically tracks the income, the revenue that's coming into the business, and the expenses, those expenses that were used to generate the revenue. And one thing I want to reiterate with you is that when you are looking at your expenses, don't think of those as bad things. Expenses are what generate your revenue. Expenses are the investment that yields revenue. You have to spend money in order to generate revenue. Now, where business owners get themselves in trouble is that they generate too many expenses that don't generate enough revenue. They spend too much money. I've done that before in my business. They spend money where they don't need to spend money, and that's what happens. If you don't have a financial statement, you won't be able to track that, and you won't know when that is happening. That will prevent you from making decisions in order to correct that action. So, how do you read a financial statement? A balance sheet. Let's start with a balance sheet. A balance sheet is a picture in time. The key items that you want to pay attention to in a balance sheet are your cash, your accounts receivable, and your current liabilities. Okay? Your cash and cash equivalents. This is the money that's in the bank. It also could be money that's in marketable securities. This is money that you can access within less than 30 days, okay? Within less than 30 days, you can access this money. That's cash and cash equivalents. Now, accounts receivable is money that is in the future that you are going to receive. It's money that you've billed, services that you've provided, that you've sent an invoice to a customer, and you anticipate on collecting on that invoice between 30 and 60 days. That's typically the collection period for most business owners. The reason why I say that those are so important when you're reading a balance sheet is because that is basically your liquidity. Your liquidity in your business is how liquid you are. How liquid you are determines how quickly you can make a decision and you can spend money on a future benefit, an asset, or an expense that's going to generate more revenue for your business. You want to create a business that's highly, highly liquid. You want your business to produce as much cash as possible, and you retain that cash for future investment. Now, I know that you probably have heard many people say that cash is trash, that cash doesn't matter. That's not true. Cash does matter. You need to be looking at your cash every day. You need to be reviewing your balance sheet or at least your bank account and get a cash report each day in your business. That'll allow you the rest of the day to be focused on the revenue generating activities that we're going to talk about on the income statement. Now, the other number on your balance sheet, how to read your balance sheet, is the current liabilities. your current liabilities are liabilities or future obligations that are due within a year. Some of them are due within 30 days. Some of them are due within 90 days. But as long as you have a positive ratio between your cash and your receivables and your current liabilities, your business is fairly healthy, as long as you don't have a lot of long-term debt. But your business, judging your business over the next 60 to 90 days, when you're reading your financial statement, it's important to understand this ratio. This is what's called a current ratio or a working capital ratio. It is the current assets, your cash, your receivables, divided by your current liabilities. And you want that number to be 1 to 2 at least. 2 would be ideal. It would be ideal that you have twice the amount of cash and receivables as you do current liabilities. That will yield a healthy business. You'll be working well. That's a good business. Now, that's the balance sheet. Those are the numbers you want to pay attention the most on the balance sheet on a day-to-day basis. Now, let's go to the income statement. The income statement is your revenue and your expenses. Like I said before, those expenses are used to generate revenue. And if your expenses are not generating enough revenue, then we have a problem, right? That would mean you're losing money. That would mean that your cash on your balance sheet would be going down and your ratio might go down as well. Your current ratio, your working capital ratio that we just went over. So when you're looking at your income statement, analyze your expenses and see what expenses are not generating revenue. And those are the type of expenses that you need to be eliminating. And until you start watching this, and I'm telling you this from direct experience, until you start watching this, you will not make any adjustments. You will continue to spend money that you don't need to be spending. And this is a daily task. This is a daily watch. See what activity goes through your bank account. What numbers were on the debit side on your bank account? Did you expense? What cash did you use? And then think to yourself real quick. This takes 20 to 30 seconds, but I'm telling you, it will completely change your business. Did that expense generate revenue? Does that expense generate revenue? Yes, it does. Perfect. Great. Move on. Maybe it doesn't. Write that down. Go talk to your bookkeeper. Go talk to whoever's in charge of that expense. Why do we spend that money? Do we need to continue to do it? And if your answer is definitely not, that did not generate any revenue, we need to eliminate that expense immediately. And that's why you got to be looking at this on a daily basis. And I would encourage you to do this even if you don't own a business. Look about this in your personal life. What expenses do you have that don't generate revenue? Now, in your personal life, not everything is about generating revenue. It's about generating memories. It's about generating, for some people, good feelings, I guess. But it's meant to have some purpose. And I guess my point is, when you're reading your financial statement and you're reading your income statement, those expenses have to have some purpose to them. And in a business, the purpose is to make a profit and generate cash. So if those expenses are not making a profit and generating cash, then they are unnecessary. So how do you read a financial statement? On your balance sheet, pay attention to your working capital ratio. That's your cash plus your accounts receivable divided by your current liabilities. If that ratio is at a 2, that is awesome. Your business is in great shape. You're looking good. If it is below a 2, you might need to do some work. You might need to go over to the income and expense. You need to go over to the income statement and analyze your expenses and see what money are you using, what cash are you dispersing every month that is unnecessary. That's going to allow you to make more money. You start watching these financials, you start reading the financial statements, producing the financial statements, and understanding why and how and what they are. This will revolutionize your business. It'll change your life. It will allow you to sleep at night. You won't be so worried about what is to come in your business because you know what is to come into your business because you know the numbers so well. Please make sure to comment below if you got any questions relative to what we talked about in this episode. Like this episode and subscribe to the YouTube channel. Please, please subscribe to the YouTube channel. We're dropping episodes, we're dropping webinars, we're dropping all kinds of information that's going to help you in your business and is relevant and real and practical, because that's the style that I like. And I know that that will help you in your business. So please subscribe, turn on the notifications so you know when we drop an episode, and I hope you have a good week.